this is clearly an environment where lots of things might change in the coming months or year. And actually, I think that the benefits of a strategy like CTAs is they're going to adapt. They have no bias or constraint that force them away from those potential opportunities. That's the great thing about our strategies. If you're a long-only equity manager, there are situations where there's nowhere to hide. Or, on the opposite, CTAs might be much more flexible and able to navigate.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup Larsen.
Hey everyone, and welcome to another edition of Top Traders Unplugged, where today Alan Dunn and I are joined by Guillaume Jamet, co-founder and co-CIO at Metori Capital Management, as part of our mini-series focusing on the one investment strategy that beat everything else in 2022, namely trend following and managed futures more broadly. First off, Guillaume, it's great to have you on the podcast. Thanks ever so much for joining us today. We really have been looking forward to this conversation. How are things in Paris this morning?
Oh, fine. We have some protest actually, but that's life in France, as we discussed.
Exactly, that is life in France. Now, before we dive into all the topics, Guillaume, that we're going to be talking about today, I would love to set the stage a little bit for our conversation so that the audience knows a bit about your firm's background. So perhaps you could share just a few highlights from its history, evolution, what type of strategies you focus on, and also where the business stands today.
Yeah, okay. So clearly we are a quantitative CTA manager based in Paris. Metori as a company started in 16 as I would say a spin-off of the alternative fund platform of Lixor. But the program is a bit more older because it started in a subsidiary, the Epsilon program, the program we manage. It started in 94 in another subsidiary of SocGen. So it's a long story. And me and the co-founder, we started to be in charge or connected to the Epsilon program as far as 11. And then a bit later, there was a spin-off. Today, we have a bit more than $800 million in AUM and a subsidiary also in China. So we're close to 25 people and we are fully committed to this one strategy, which is deep trend following.
Which is great. That's what we love to hear on this podcast, Guillaume. Now, as you probably know, today's conversation is going to be, a list of different topics that we often get asked and also that we find interesting, but we may not have time to discuss all of them. So what we plan to do is just to pick a few along the way and just take it from there, really. And as we normally do, Alan, why don't you kick off with the first topic?
Great. Good morning, Guillaume. Thanks for joining us. I guess we normally like to start by getting a sense of the investment philosophy of the manager. And I guess how was it that you came to focus on a trend following strategy? What is your belief about markets and how do you operate that brings you to kind of focusing on trend following as a core strategy?
Okay, so I can make a long or short answer because the how I ended being a CTA manager is a long story, and it was not clear from the start that I would do that. I'm a pure mathematician at first, more directed toward academic world, and for many reasons, some connected to money, I moved to the finance around the 2000s, and I was more in the derivative business, okay, the complex models, stochastic calculus, and and all those things. And it was a very interesting period. I witnessed the GFC, by the way, from a nice point of view. And later, I moved around 2010, I moved to fund management at Lixor and quantitative fund management, obviously, given my background. And in 11, I had the opportunity to connect and be included into the Epsilon program at the responsible head of research. And at that time, Nicolas, our co-founder, was CIO of Lixor. And we had the same, I would say, engineer, mathematical background, and we were very interested by strategies in general, because maybe it's something obvious, or I don't know, when you come from the world of quantitative finance, interestingly, you're not interested at the expected return. You're interested at understanding how risk change, the correlations, the forward volatilities, and so on. Well, obviously, that people come to market because of the expected return. So there is something very strange that in the derivative world, you don't want to predict expect return, you don't care because you hedge them actually. So we came to the world of asset management with a strange background and so we had a very fresh look. Obviously, I think that with this scientific background, something like trend following make the most sense, because that you need to have a risk premium. An expected return in front of a risk is a necessary condition for market to exist. Nobody would take risk without expected return. So the next stage, when you're mathematically inclined, is how should I measure that? Because the market, I have the full thing in the market. I have the expected return. I have the trends plus the risk, and I have to kind of filter them in and out. And it's a very natural and scientific problem. Actually, it's called stochastic filtering or whatsoever. And this is and when you discover market with this angle, and I know it's not the majority of market participants that sees a world like that, you understand trend following at this sort of filtering problem.
Okay, interesting. And many people would say trend following is a fairly simple idea of you're basically buying price series that are going up or going down. Obviously you come from a bit more of a complex mathematical perspective. Do you think that is necessary, or is that just an additional kind of perspective to bring to the risk management in particular, or also to the kind of signal generation?
I think the intuition behind trend following, you don't need all those maths to see that sometimes market are consistently going into one direction, and maybe it's even model that says, okay, and it lasts long enough so that when I see that trend, I will benefit from it lasting a bit more, because the problem is that obviously when you enter, you can have that very intuitive or basic observation. Then the name on the game is going to measure things and decide when it is a trend, how strong it is. So like many things, I have a father that is an architect, and obviously people have been building houses and bridges and stuff much before engineering and physics, and they were quite okay. It doesn't mean that I think engineering add a bit to the world of building. As simple as that, maybe.
Yeah, and obviously there's plenty of kind of sources of potential return, but have you focused more on the pure trend following, or is the philosophy trend plus other strategies?
Yeah, we are pure trend in the sense that, yes, we don't want to add other sort of carry and stuff like that. This being said, the pure trend thing, I'm a bit uncomfortable, because again, it adds to the idea that trend following is simple. And I think that doing it right is not simple. So I don't like the word simple. It's almost synonymous to cheap, which is something I would not. So, and I truly think it's not simple. But yes, no carry to be clear on that. But we believe also that taking into account correlation, which is an important ingredient of trend following, adds the loss of complexity and value if you do it right.
Yeah, no, obviously you clearly come with a scientific background, so you will probably dismiss the next term, Guillaume, that I'm going to bring up, and that's the Sharpe ratio. We've referenced a paper that Cliff Asness and his colleagues wrote last year, and it kind of raises a few questions, such as, what are the true mandates really of CTAs, etc., etc. But to make it very simple, what it comes down to, and this is probably something that you don't think is a good idea in general for investors to do, but most investors look at the Sharpe ratio as some kind of measure of quality, even in the CTA world. But the real question comes, at least in our minds, this thing about, well, whose Sharpe ratio should we then be concerned about? Is it the Sharpe ratio of the managers? Or is it the Sharpe ratio of the overall portfolio of the client once you include these strategies? And I'd love to hear your thoughts about that. I'd love to hear maybe how you steer people to look at other things than the Sharpe, even though I have to admit it is pretty difficult to get away from that specific ratio in our industry when people do some kind of analysis on the strategy.
Yeah, so maybe I'll surprise you on that, because actually I think that the Sharpe ratio is quite a good measure of a strategy. It's difficult it's going to be difficult to find a different. You can add other metrics which will be important, but when you only have the track record of a fund, a strategy, it's really reasonable to start from I find it reasonable to start from the Sharpe ratio. Obviously, Sharpe ratio is the good measure of return adjusted to risk. So the first maybe thing is, are the risks well reflected into the volatility? I'm thinking about carry strategy. Here in carry strategy, you have a problem. If you sell, you sell the wings, an option game where you sell far out of the money, for a long time, you may have no volatility on collect premia. Obviously, you would have a wonderful Sharpe ratio. And here you would say, well, it's because the risk of this kind of activity is not reflected into the volatility. But for a directional strategy with using linear instrument like a trend following, it's hard to say that you should not look at Sharpe ratio. I think you should. The other interesting thing are where come the returns from. So it's more about the correlation with equity market or some structural correlation with other markets. Then there would be the question of beta and alpha, which is not an easy one. But if you have no structural correlation to the main risk or markets, and you have a good Sharpe ratio, it looks you are quite doing a good job.
So you are actually, you're right. You are surprising me a little bit here, Guillaume, which is great. So I'd love to explore this a little bit further, in the sense that some people that I speak to, and I think they kind of have a point, and that is, well, we all know, of course, that the Sharpe ratio kind of penalizes the upside volatility. So that's always been a little bit of an issue. But the other thing is, of course, that the Sharpe ratio doesn't really say much about the risk of big drawdowns or the risk of completely, a strategy blowing up, as we've seen so many of these high Sharpe ratio strategies do. So how do you adjust for that in embracing the Sharpe, actually?
If I understand well your question, that the point that Sharpe ratio is a measure of is supposed to be a measure of return adjusted to risk, and when you use the Sharpe ratio, you made the hypothesis that the past realized volatility is a good indication of the risk. And obviously, we know that there are very specific strategies. The carry strategy, when you are selling insurance selling strategy, all those sort of strategy, you are going to collect the insurance premia very consistently, so almost linear return, and you hope that a tail event or a more exceptional event do not occur. And obviously, when you look at the track record, if the exceptional event have not been occurring into the 1 year, 2 year, 3 year period, you may, and you believe that the risk is encoded in the volatility for this track record, you're doing a big mistake. But I think that typically for a strategy like a CTA, I don't see what you could do better. I understand that they are more subtle sort of risk, but for strategy using linear exposure to market like Futura.
If I could jump in, if you were to measure maybe the Sharpe of various trend following programs, for the period say 2010 to 2019, and that would have been a decade where you didn't have, say, a major equity drawdown, and then you were to rank those trend following programs on the basis of their Sharpe, then you might. Some of the managers or programs that did best in terms of Sharpe may not then do it that well once you go into maybe a 2020 type scenario or a 2022 type scenario. So I think that was kind of the idea behind the Cliff Asneth's paper, that obviously Sharpe is a good measure of risk-adjusted return, but it doesn't tell you about this kind of second possible mandate of crisis alpha.
Okay. You thank you for reconnecting me to the initial question. There is this promise with trend followers. You are talking about the crisis alpha things. I look at the trend of our strategy or peers, you see this crisis alpha thing that's been occurring, obviously, and it's very present, and we understand why. It's about convexity. When you do trend following, you're sort of implicitly, so it's again my maybe option background, you're all sort of replicating a basket of straddle, okay, some convex profile. And so obviously when things start to move quite consistently, quite strongly in some direction, you're going to adapt and catch that. So this is convexity, and that's a really great property of CTAs. But maybe there are type of crisis on situation where I would not bet that in any case CTAs would procure. They are not a hedge. You can't claim that you're uncorrelated and claim that you're an edge to something that's inconsistent.
I guess I think the general point is around obviously Sharpe, as you say, it's capturing the risk-adjusted return, but then as you say, you've got the higher moments of the distribution, the skew, etc., and then obviously, from whether you believe in crisis alpha or not, the characteristic of how well the program might deliver in a significant crisis period or equity drawdown.
So but again, I think that the what we try to achieve, at least I'll speak for ourselves, have a CTA, a trend following that behaves as best as possible in all market regime, and not only wait for the next equity drawdown. We don't manage. I would only say that we don't manage the fund in this perspective. We believe that there are many macro surprise, lots of different source of risk in the market, which may have their trends, and we'll try to catch all those and diversify as much as possible.
No, makes sense. So, I mean, it's because we have spoken to other managers on this podcast who have emphasized the more of a defensive nature to trend following, and others have balanced absolute return versus crisis alpha characteristics, and then others like yourself who are more focused on the absolute return. Sorry, Neil.
No, it's fine. No, I'm still, because obviously there aren't that many ratios as such, but for example, and I don't know if you're familiar with this one, Guillaume, which is the serenity ratio. And the serenity ratio also takes into account the actual drawdowns and the path dependency and so on and so forth. And I know it's too complicated for most people to calculate anyway, and it's not something you would universally look at. But for, say, a CTA strategy, it's kind of an interesting ratio. But let's not dive in too much into that. Let's jump into one of your favorite topics, or wherever you want to go, Alan.
Yeah, I mean. Obviously, Guillaume, you mentioned kind of you've been involved with the program since I think around 2010 or so, 2011. How has the program evolved over that period? And I guess from a research perspective, what have been the things that you found that where you can add value as a researcher in a trend following program?
So over this period, quite long now, the program did evolve a lot. Actually, we made a major change and evolution of the program that was in place at the end of 12, where actually we completely moved from a more maybe traditional approach where you had, lots of signals and an optimization of combination of signals, which are in fact technical analysis and coded into a computer, more or less. And then a quite very robust, but maybe too basic, equal volatility or equal risk budget allocation. And we moved to something different where the detecting trends became then a really statistical, or you could say signal filtering problems. And my conviction was that correlation should be more taken into account both at the portfolio construction stage, which people will easily agree, even if not so many people really account for correlation, but also at trend detection part, because actually, if you believe that markets are connected, then why behaving as if they were not at the first stage? So something more statistical and I would say joint multivariate or all over the investment process. This was the major change. And then when you do this kind of systematic quantitative thing, there's always question that you should come back and improve. There are continuously questions that you could dig further, design choice that you have made that you may challenge or improve and so on. So it's a continuous thing.
Okay. So you mentioned a couple of interesting things. I mean, the signal, when you say signal filtering, how would you explain that to the layman? And then secondly, embedding correlation. So I guess from that perspective, you're trying to avoid making bets on what is effectively the same trend in multiple markets. Yeah. Okay.
Yeah. So trend signals, you're right. They are a bit buzzword and not very clearly defined. So it's expected Sharpe ratio. We want to think about expected return, and because in a CTA universe, the volatility of the market returns are so different, from less than 1% volatility to maybe sometimes close to 100. It's obvious that when you want to look at this large investment universe, you're going to factor the volatilities of market quite systematically. So signals mean expected Sharpe ratio. It's as simple as that. And then you choose your weapon on how to predict or estimate, and that's yeah.
Okay, so I mean, is that sense, are you saying that for every signal that you're getting in each market, you're assessing the expected risk-adjusted return for that individual trade? Is that it?
Absolutely.
Yeah. And from the perspective of correlation and kind of, as you say, not wanting to reflect the same broad trend and themes in multiple exposures, how do you go about doing that? Is that, I mean, people have different techniques for looking at that. Some people say, you use principal component analysis or group markets into, or manage the risk by different sectors or by similar instruments. What's your philosophy around that?
So yeah, the philosophy is to listen to market data first, avoid any predefined sector groups or predefined, budget across, anything, because you're going to create bias in your strategy, and your bias may come from past experience, so you may introduce. Yeah. So yeah, this is about estimation of correlation, and actually it's a difficult thing. So lots of people talk about it, and it's very intuitive. But when you want to have a dynamic estimate of correlation, and you have to accept that this estimate is going to be somehow noisy. But interestingly, people get afraid of estimating correlation, and in particular short-term correlation. And there is something very funny that everybody is almost perfectly okay to make a prediction on expected return, and very afraid of making prediction of correlation. But if I could earn my living by predicting correlation, I think I would be much richer than I am today. So it's very strange that people are very confident on predicting return and very shy on the use of correlation. And the principle we put in place are really around challenging all those rules that were more, I would say, custom than scientific truths, and check what is really. Typically, you have heard that Markowitz not working. This is something you hear everywhere. Well, actually, I mean, what we did is let's look at how is it not working, and maybe there are things we could fix. And this is our approach,
Interesting. And I mean, that's what, I mean, you're right. Correlation is something that maybe doesn't get a lot of time. And everybody knows, you can basically plug in correlation into the Excel spreadsheet to figure out what the correlation has been over a time period.
It's not going to work well if you do that, indeed.
Yeah, so I guess there's two things. One is what's a better technique, and the second thing is what's the right time frame.
There is this thing, Heisenberg uncertainty principle. You heard of that, I think, which is that you want to estimate an instantaneous quantities that you don't observe, so you would like to make the shortest time frame. The problem is the shorter the time frame, the higher the uncertainty and the noise around it. And the trade-off is going to be this unobservable quantity. How fast does it move? If it moves slowly, then you can take longer-term average to cancel out noise. If it moves fast, if you believe it's moving fast, you have to accept the noise, because if you want to have you want to follow the changes, this fast-moving thing. So this is where you at some point statistics won't be able to answer all the answer. You will have to have assessment of, I think this is a fast-moving thing. I think so. I'm not directly answering your question. I think that for volatility of correlation, the shorter the time frame, the better at first, but then you will have lots of noise.
Okay. So, no, I mean, that's exactly it. I mean, I guess that's the nature of correlation, that it can be, even taking the bond equity correlation, for periods it'll be negative and then suddenly switch to positive and then switch back again. So I guess that is the nature of correlation.
And that's the true difficulties. That's where the true difficulties will come when you do this simple trend following thing, is when you really want to find the best way to estimate. And then if you accept some noise in the estimate, how to limit the impact and how to limit the overreaction on the noise and so on. So that's where you start to see that it's not that simple.
And in terms of estimating volatility, is it the same philosophy of shorter look back and being more market sensitive is better as well?
Yeah, this is this is the approach. Yeah, for the volatility of correlation, clearly, which is very challenging in terms of portfolio construction. That's why people say that Markowitz not working, and that's why they end up taking 1 year correlation. And obviously, when you do that, you may miss a lot of change of regime.
Yeah, no, just staying a little bit on kind of the strategy of the program, the design. Obviously, most strategies have to select parameters to go into the model. And I'm curious whether this is also something you've managed to completely systematize in terms of selecting the parameters and also changing parameters along the way from a systematic point of view, or is there some kind of decision-making process where you have to do it kind of by committee or however I should say?
Okay, and very, very. Thank you for this question, because I think that when you present yourself as systematic or quantitative, there is something unclear about it. May be quantitatively assisted trading or quantitatively assisted portfolio management, which is fine. So you have lots of systematic and quantitative things, but on top of that, you have an expertise and discretionary choice. And I've met lots of great people in this industry doing that. So here, when we say systematic, we really mean systematic. The model we put in production, when we put it in production, this is because we believe that it is the best model with the best parameterization we know of. It would have been the best in the past. And so it's not part of day-to-day or even of recalibrating, changing things. And that's very important. The parameters are the really meta parameters, the things at some point you have to make some design choice. Some
universal truth that you believe in.
Yes, I know it sounds very naive, but it's also it has more to do with trying to have a scientific methodology, because at the opposite, if you have a model with parameters and your approach is that every month or every quarter you recalibrate for data, or you recalibrate from investment committee, then actually you cannot use backtest if you do that. You agree, because you cannot backtest your investment committee, and if the automatic recalibration just from data, if you will always do it the same, then you should automate it. It should be part of the model, and then actually you're not changing things. But usually you know that this recalibration, they are somehow discretionary. They are on demand and on feeling and so on. Why not again? But then if you do that, you really cannot use backtest, and it's going to be quite difficult to use historical data in some way.
Yeah, no, absolutely. Now, you've mentioned a few times, which of course we all agree with, and that is that CTAs and trend following, it's not as easy as people may want to make it sound like. And of course, this has been sort of an on and off debate on our side, and that's this thing about can CTAs be replicated, and there are different approaches to that. Some people try and develop trend following models that they're happy to kind of make reasonably transparent if they want to put it in an ETF product, etc., etc. And then there are people who will just analyze historical returns and try to replicate. Since you have much more mathematical background than I do, I'm just curious, and also because although this episode will come out after my next conversation is actually going to be with a replicator. So do you have any views on replication and maybe in particular this the type of replication where they do some kind of regression analysis of returns to try and estimate what exposure CTAs might have?
So this is very interesting and tricky question. I think you mentioned two very different directions, which is one is oversimplify and kind of open source CTA in a way, and the other which is you reverse engineering the existing manager and find what they are doing. I think the problem has to do with simply with fiduciarity, because if on one hand you say I commit to think that everybody knows and it's going to be very simple because I want to be very transparent on everything, it's a limitation. So maybe the argument is going to be less of fees, okay? But it's a limitation. It's a strong limitation because obviously you don't want to work hard on improving something and then give your portfolio almost every day or display the formulas and anything. No company would do that. So maybe some investors find their reasons to on that. And for the replication, again, the problem with fiduciarity is quite high, because how do you feel responsible for the portfolio and the decision you take when you are just trying to filter the returns of others? That's
No, they're a valid point. They're good points. So let me, before I hand it back to Alan, so let me then turn it to, in a different direction. Namely, so let's just say that people agree, I guess, with all of us that it's better to choose a manager. I have two questions for you, really. One is, if you were on the other side of the table, looking at managers, knowing what you know about design of systems and so on and so forth, I mean, what would be the things that you would look at in order to evaluate? Because I think our clients generally have a difficult job in deciding between managers, because in many ways, we kind of look the same, unless you say, okay, well, he trades 400 markets, he trades 50 markets. Okay, that's the difference. But the performance may not be that different, frankly. So from looking from the inside, with all the knowledge you have, Guillaume, how would you advise investors to evaluate different types of strategies within the CTA space or trend following space?
Yeah, so I think that's a very difficult job to select manager. I don't pretend to have the silver bullet to select good CTA from the outside. Honestly, maybe if the manager, for a manager that came to be quantitative and systematic, obviously I would have more high suggestion of question to ask. Maybe. Typically your question of how frequently you reparameterize and stuff like that is a good indication, because I would not be very comfortable with that, because then maybe the track is more the result of the clever reparametrization or reallocation across strategy and all those things. So you are just the fact that maybe it's not so systematic that it pretends to be. And this is what we do as a company, is to be as transparent as possible on providing data on the history of the fund, because it's obviously going to help investor understand where the returns come from. I think the question, we are investor with our own money, by the way, is you don't want to put money in things you don't really not sure you understand what they are doing. So it's simple as that. We believe that we try to be as transparent as possible with investor on providing data, explaining what were the risk, where do the returns come from, and I think that's. I think it's necessary to reinsure yourself on where you are putting your money.
I know you mentioned you obviously have a subsidiary in China, so obviously presumably trading the Chinese markets is a key focus. So I mean, a big kind of topic and debate we've had here on the podcast is in terms of what's the right number of markets to trade and market selection, and is there a benefit of trading lots of more and more markets, and particularly from the perspective of the alternative markets, which I guess, the Chinese markets would be in that subset. So what's your perspective on the benefit of trading those markets?
So we have a version of the strategy on Chinese market, which is for onshore Chinese investor, by the way, currently, which dates from 2014 and which had incredible return from it. So it's and also from our research, it obviously is very those returns are very complementary to the Western trends and the Western returns. So the strategy is quite obvious: is we want to have the larger investment universe, Western market and Chinese market, and more generally, the at first order, the question is the larger investment universe, the better. Obviously, but then some difficulties come. Is that this first order answers come to the fact that you say, okay, if all those markets are uncorrelated, then clearly the larger the better, and your Sharpe ratio is going to improve as square root of the number of markets. This is this rule of thumb. So it's wonderful if you start to compute a square root of 10, 100, and say, wow. But in fact, those markets are highly correlated, and that's why CTAs do not have a Sharpe ratio of 400 or 500%, and that's because markets are correlated. And so this is where again we have to dive into the detail that you should have the larger investment universe, but not for the sake of having the larger number of investment, for the sake of getting a grasp on new risk factors, where you truly new risk factor. Okay, but obviously, if I had more and more European equity indices to my investment universe, it's not going to change things much. We know that. The question is going to be the marginal benefit of adding a new market, which might be very small, and maybe sometimes the operational cost of adding this market, because you start to go to non-deliverable currency, non-listed investment. So you add some specific risk and difficulties, and the question is going to be the data quality. Maybe sometime at some point is going to be an issue. So in practice, we will not jump on any new market, because we are very doubtful of the true addition it will add.
So basically, more markets can be better if they're genuinely picking up new risk factors, and you think that's the case in China.
And do not add specific risk or cost to the strategy. And the question is, and liquidity is obviously one of the question, because if you start to, and if you want to have scalable returns, then there are markets you're going to have some issues on trading them significantly.
And so your flagship now is incorporating the Chinese exposures as well. Is that right? Alongside?
Oh, not currently. We are close to starting a new flagship with the largest investment universe, and including China. This is the big project for 23.
Okay, interesting. And obviously, you're talking about risks. I mean, how do you think about the risk of trading in those markets where you may have geopolitical concerns or kind of tail risks of markets shutting down or capital controls being brought in, etc. Obviously, these are all kind of risks that are not, as you say, captured by volatility and the distribution of returns.
Yeah. It's difficult to make a generic answer because actually it's precisely depending on the type of market to understand maybe those specific risks that are not into volatility. I mean, if you look at Western market, we had lots of great surprise, not recently, or I think of, central banks from time to time. So we don't need to go to China to find a surprise. And obviously, yes, the non-deliverable currency add a layer of difficulty. And we try to, we try to recognize all those risks. And then I think that our model framework is nice enough so that we can put a price on those. So typically, we don't claim that being long gold in China is completely economically equivalent to being long gold in the US. And if we just want to be long gold, it would be better to be long gold from the US than from China, because we acknowledge that there are specific risks linked to Chinese position. I don't want to stress on Chinese. It would be true for all those markets. You counterparty risk as a general rule, simply, or illiquidity risk at the general. You need to put that in your model so that it not freely choose, the good old gold future or a sophisticated TN in some strange currency. I don't know.
Yeah. Okay. So I mean, it sounds like very much more markets is better, but it's very much on a case-by-case basis. That seems to be the philosophy. I mean, beyond trading Chinese markets, do you see another source of opportunity beyond there, like over the next number of years, that you think might be interesting?
When you look at the liquidity of future market, the biggest commodity market are Chinese market. So it's very. There are few US market that looks big, but many of them are Chinese markets. So it's just very natural to have a look there. And then we want to enlarge the investment universe, but we want to be cautious at the same time, or sparse in terms of the operational cost and liquidity risk.
Just staying on China, it's not a market that I have any experience with. But one of the things that we see more and more, and that we get asked more and more, and especially to fill out certain questionnaires, is ESG. And I have to say, I have personally struggled a little bit with sort of the where do you draw the line in terms of our industry, our strategies, relation to ESG? But frankly, and I don't want to sort of, but frankly, to me, like a country like China might be a little bit different in terms of ESG. So how do you think about that if you open it up to kind of more investors in a new flagship strategy?
ESG is clearly a big topic. I think that the main difficulty is that when you are a CTA, it's very difficult to first build a measure of any ESG risk, because you aggregate financial of all currencies, all type of financial equity, bond rates, foreign exchange, commodities, and you need to have a measure. And if you look at what exists currently in the ESGs, you have scores by kind of instruments, scores on equities, scores on bonds. But obviously, when you go short, it's not clear how to use those scores if you go short. So what we have done in terms of ESG is to how do you aggregate scores from different sources? How do you mix them? How do you account for the long or the shorts? And we came with a methodology that we have been sharing with investors, academics, and the feedbacks are quite good. And we had the opportunity to talk, I think, in some conferences few months or years ago. I don't remember. And this is where we stand. First, trying to know what we're talking about, having a measure of thing. And obviously, at the end of the day, some investor, we have a version, the UCITS fund we have do not include commodities. And for many European investors, it's just like that. But they prefer to stay away of commodities. And obviously, adding Chinese market, you may have the same, some investor might, yes, draw a line. Obviously.
No, I mean, that's fair. It's actually, funnily enough, it's a question that is super difficult, I think, for all of us to kind of talk to. And so I appreciate, because you probably would have done some work on this as you've indicated. So I really appreciate that. Just another question that sort of springs to mind as I sort of see people's reaction to what's happened in the last year or so, in particular, where, as I mentioned in the introduction, CTAs, managed futures more broadly, was really the strategy that beat everything else last year. But often people still, I don't think they truly embrace having these strategies as a core investment at all times. They probably think, well, if it did well, it's had a good run, let's just get out, or let's reduce, and we'll do something different. I mean, I know you are not necessarily on the client-facing side of things, but I'm sure you discuss it internally. I mean, what do you think is some of the hardest thing, and how do you think about overcoming that in the way you communicate with investors and potential investors, in terms of getting people to embrace what we believe should be a core allocation at all times in a portfolio?
To have investor getting in on with the right expectation, actually. Because the investor getting in after a fantastic 22, there might be some disappointment, because obviously all years in a CTA. If you already claim that on the long run you will have a 75 Sharpe ratio, which would be great for a manager, I don't speak about 100, then I think it has to do with the statistics of the Sharpe ratio, actually, that if you look at, it's difficult to estimate the Sharpe ratio. You need lots of time, and you have to admit that 75% Sharpe ratio, which again is a great Sharpe ratio when you look at the long-term numbers, all the years are not going to be positive and pleasant. As simple as that, I would say. So, and it has to do also with, in fact, behavioral finance, that we are risk-averse, we are loss-averse, we focus on the short term, and we are fooled by randomness very frequently. When you practice statistics, it's kind of helpful, because you have you can put some numbers on that. But when it's money, it's difficult, because it's we all hate losing money. But this is I think this is the beginning of the discussion with investors, that appreciating that it's hard to measure a Sharpe ratio. You should accept some volatility to get some return. Trying to time CTAs, I mean, I don't know how to do it, because obviously I would just put it in my model once for all.
It's funny you say that, because that's exactly what we say to clients and potential clients. Don't try to time it. We don't know. Even us who look from the inside, we have no idea how to do it. Yet that's what they do at the end of the day. So it's kind of an interesting dynamic.
Yeah, it has to do also with the nature of risk. It's because you have if you believe that the risk of CTAs is the classic random noise, Brownian motion, sorry for this word, and convexity, then obviously you have to accept that there are going to be boring period with no return on volatility and, rally of performance from time to time. You can't time that. You have to be on board already. And actually, if you compare to carry strategy, where you are going to have long period of steady return and sudden burst, then maybe you could try to time that, to time the moment to accept. But so maybe people also are applying to one type of investment something that is just not the right tool. You can't time maybe it's difficult to type a volatile and convex strategy.
Yeah, no, I agree with that. And I think you're right. I think investors, and including ourselves, of course, to some degree, I mean, we are conditioned by everything around us. And there's no doubt that, timing investments is something that people spend a lot of time doing. And also the so-called experts on financial media will try to do it as well. So, no, but I appreciate that. And then where do you want to go next? Maybe we have 1 or 2 rounds left before we wrap up.
Absolutely, yeah. So maybe just to delve into then, we talked about the client perspective. So thinking about the role of trend, obviously in a broader multi-asset portfolio, it'd be good to get your perspective on the typical questions is kind of that when you speak with clients is how much to allocate and how, is it more funded out of the bond side or the equity side? And obviously if you run kind of historical optimizations of kind of bond equity trend following, you'll tend to get a much higher allocation to trend following that you typically see in investors' portfolios. So do you think that people just, do you think the allocation should be higher in line with those optimizations or not?
Yeah, you can't deny that when you have if you have a strategy with a significant Sharpe ratio, very on the long run, very in line with the Sharpe ratio of equities or bonds. On the long run, not only the last 10 years, and close to, on average, zero correlation. I think it's going to be difficult to find a reason not to put some significant share of that into the portfolio. But obviously, it's not that easy because you have to. It's not going to be an easy investment decision, but we see the many, I would say, highly sophisticated institutional investor that came to a conclusion not so far from that. Where I'm not an expert in the US market, but apparently CTAs have a special position among all this sort of edge or alternative strategy, and they're called also risk mitigation strategy. And it says something on the fact that you have a class of investors that understand quite well their benefit into a portfolio.
Yeah. And I guess kind of adding trend following or managed futures 101 is to, yes, let's have an allocation. You then take some of these institutions who say, well, we're going to use trend within the context of a multi-asset portfolio. So is there something that we need to do to the trend following program to optimize it in that role from the perspective of should we cap the equity beta or should we, look at the speed of it to give us more protection and drawdowns, etc. Any perspective on whether they are good ideas or not?
So again, I think being an investor is a difficult job, and it's so I would not want to give advice and claim that I would be smarter than them because it's it sounds very natural. So okay, if I know that I'm going to put this CTA with my bond and equities, maybe I should tweak them a bit. The problem when you do that also is that you're going to confuse responsibility, because it's a problem of having overlays and delegating overlays, because we want to manage a strategy that have to not make money when equity market are down or whose quality depend on something that you don't control. It's going to be difficult to share responsibilities and benefits in this framework, but I understand the reason. So if you believe on the long-term statistics and say on average correlation is going to be zero, Sharpe ratio should be good, risk is quite well managed. This is one of the great characteristics of CTAs. Maybe I'm wrong, but I've never heard of CTA blow up or CTA drama. Correct me if I'm not the oldest and the most experienced, but it's compared to other type of strategy, it's quite remarkable. This positive skewness also, that you don't discover the risk when things go really bad.
Yeah. Okay. And maybe just quickly, obviously you mentioned how these strategies have found a niche and a place, particularly in institutional portfolios among public pension plans in the US with this kind of crisis risk offset label or crisis risk mitigation strategies. And it does seem, maybe in Europe, there's obviously plenty of investors in trend following, but maybe we don't see that to the same extent. What's your perspective on why there's been less of a take-up maybe, or less investing? You certainly, if you look across the wealth management space and multi-asset funds, you don't see it well represented, I would say. Curious to get your perspectives on that.
I don't claim to know, have a global view on what investors are doing in US and Europe. So it's always quite difficult to answer those questions. I think maybe there are still misunderstanding on what it is. That it's the word hedge fund. Sometimes maybe might say, okay, it's maybe too funky, too exotic for my portfolio. Well, actually, it's very liquid instrument, and maybe it has to do with that. You compare to the most famous hedge fund strategy like the long short equity. Maybe a too simple explanation where go along the good one and sell the bad one, and you take cars, you take computers, say this one is the good, this one is the bad. There is a story. People understand that if you're good at detecting the best car maker and detecting the worst car maker, you should do the obvious long short. And for CTAs, I know it's more complex to explain. You're using like correlation, convexity. I'm the first to do it, and so it takes more time to explain.
It's funny you mentioned these things, Guillaume, because actually in some of the conversations I've had this morning here in Asia, some of those very topics came up, and so I think it is interesting. But let's just imagine people listen to this conversation, Guillaume, and they finally, it makes it all clear for them. Your explanation makes it all clear, and we see a big inflow of money to trend following, which would be wonderful. But from a mathematical point of view, from a research point of view, Guillaume, because I think that's the other thing that people will. I think people like finding kind of excuses as to why trend following shouldn't work or should continue to work, even though we have 50 years of proof, of real data, right? But is there such a thing as too much money in trend following in your mind? Because we know that the industry as a whole hasn't really grown for a long time. Like 20 years, the AUM is probably the same. And, the AUM is slightly inflated, I would say, because they include Bridgewater, which is not really a trend follower, in my opinion. But then, of course, we also know that there are a lot of people doing it probably internally, and they're not part of any index. So there is more money than what we see, I'm sure. But is there, and I don't want to impose my opinion, but is there, in your view, other than on a manager level, where clearly capacity can be an issue at some point, but is there, from an industry point of view, any argument to say, well, I'm concerned about all the money in trend following?
I think there was a risk and interesting views on that on the FT, if I'm correct, about CTAs are more minnows than
Rob Carver's article. Yes, absolutely.
I have exactly. I was very happy to read that because it's exactly my opinion coming from just numbers of the number of managers, the UM in the industry, the level of the magnitude of the leverage, and you look at front of that of the size of the currency market, the size of the bonds or rates market, the size of CTAs presumably is ridiculously small, in fact, compared to the size of other market participants. I'm skeptical in the sense that I don't know, but I'm always skeptical when I see those comments that CTAs did move market. Actually, if we are trend follower, we never move market. We come just afterward. We are not that smart to move market. So maybe sometimes we overreact, but given our size, I reduce. But I know it's a very popular explanation. I cannot find a single figures or statistics that could. All the numbers I see would say that it's not.
We're far from any risk of that. Yeah,
I keep hearing that. So.
Yeah. And it's actually, interestingly enough, even though you said you haven't been in the industry forever, but that's the other thing that came up in my conversation today was actually this thing about, has there ever been a well-known CTA that's blown up? And actually, I would agree with you. I can't think of a single one as well. So I think there is something incredibly robust about what we do. Now, just two things that we'd like to ask everyone, Guillaume, before we wrap up. And I have a feeling what the first answer might be, but I'm going to throw it at you anyways. And this thing about, if there's one thing that you hear people say about trend following, so not your opinion, but if there's one thing you hear people say about trend following that you really disagree with, what would that be?
So there are not only one, but I will pick this one.
You can give us two or three. That's fine.
Yeah. Okay. No, the first one I think, and I think the reason why I don't like those things that it's going to create mis-selling or wrong expectation, and I prefer you prefer to have investors that understand what they are in, what they have invested in. So the first one is CTAs are long volatility. That's plain wrong. I mean, actually, we churn on volatilities and CTAs. I mean, our strategy, as I understand, is we are long dispersion maybe or large move, but and I think this one is very toxic because then when you remember, so maybe it's over now, but all during that period, 10 to let's say 20, anytime the equity market would spike down for a few days, you would have people say, but CTAs did not go up, and that's too bad because it means that, and there were lots of comments on that, and it means that there was a complete misunderstanding of what to expect from our strategy. So this one I think is very toxic.
That's fair. Yeah.
CTAs are long volatility. And yes, also about timing CTAs. I mean, this is not helpful comment.
Sure. Do you want to throw in a third one, Guillaume, since you're on a roll here?
No, I think it's okay. Thank you.
Okay. I was expecting, the one I was expecting from you was this thing about the trend following is easy, but I think...
Oh, yes, you're right. Obviously, yeah, no.
Fair enough. We're only in the early part of 2023. That's already been lots of interesting things, exciting things happening. Looking at the rest sort of the year, I imagine that the launch of your new fund will be exciting for you. But is there anything, in looking at it at a whole, and not necessarily just on what you do, but maybe at the industry level, or maybe even from a completely different viewpoint, is there anything that excites you, or is there anything that you're concerned about when you look at what's happening right now and how it impacts some of the things we do, maybe as an industry?
Clearly, since 20, we're witnessing so many events, change of regime, and I think that we are really into that. I mean, it's carrying on, the debate on inflation and rates, and the impact of high rates, the continuation or not of hikes. Many people think it's over, but so this is clearly an environment where lots of things might change in the coming months or year. And actually, I think that the benefits of a strategy like CTAs is they're going to adapt. They have no bias or constraint that force them away from those potential opportunities. That's the great thing about our strategies. If you're a long-only equity manager, there are situations where there's nowhere to hide. Or, on the opposite, CTAs might be much more flexible and able to navigate.
Yeah, no, I agree. I think nimbleness and flexibility will probably be in high demand as we work through this environment. Guillaume, this was really fantastic. Thank you ever so much for a truly fascinating conversation. Thanks for being on the podcast and sharing your thoughts and insights with us. And we hope we can do this sometime in the future again. And to all of you listening today, I hope that you were able to take something from today's conversation onto your own investment journey. And if you did, please share these episodes with your friends and colleagues. From Alan and me, thanks so much for listening. We look forward to being back with you on the next episode of Top Traders Unplugged as we continue our deep dive into the CTA industry. And in the meantime, go check out the show notes for this episode and all the other resources you can find on our website. And not least, as usual, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.